Tesla's meteoric rise in market capitalization, surpassing all major automakers combined, has generated widespread debate about the sustainability of its stock value. At its peak, Tesla's market cap hovered between $800 and $900 billion, far outstripping the likes of Toyota, Volkswagen, General Motors, and Ford, even though these companies produce and sell vastly more vehicles. The disconnect between Tesla's production scale, profits, and market valuation raises concerns about the speculative nature of Tesla's stock investment, as well as the long-term viability of returning meaningful profits to its shareholders. This video will set a critical focus on how Tesla's valuation reflects investor optimism rather than business fundamentals, and why the current market cap is unlikely to yield tangible returns from the company's core automotive business in the foreseeable future. Tesla's rise to dominance in the stock market in the past decade is largely driven by factors other than its core business of manufacturing and selling electric vehicles, EVs. In 2023, Tesla reported revenue of $24.3 billion in Q3 alone, a significant increase from previous years, but this pales in comparison to the company's massive market cap, which hovers around $800 billion. Compared to its competitors, Tesla's vehicle sales are a fraction of what established automakers achieve annually. For instance, Toyota sold over 10 million vehicles in 2023, while Tesla delivered around 1.8 million during the same period. Yet, Toyota's market capitalization is less than one-third of Tesla's. This disparity highlights how Tesla's stock price is not being driven by traditional business metrics like vehicle sales or profit margins, but by investor sentiment tied to future potential. Investors seem to bet not on the profits Tesla generates today, but on the company's potential to revolutionize industries in the future. While Tesla has indeed been a leader in the electric vehicle market and spearheaded innovations in battery technology, it is difficult to justify such a high market valuation solely based on these factors. In 2023, Tesla's net profit was approximately $12.6 billion, which is a strong figure, but relative to an $800 billion market cap, the return on investment is limited. At this scale, Tesla would need to exponentially grow its sales and profits to provide returns that align with shareholder expectations, an outcome that appears highly unlikely given the competitive nature of the automotive market. Tesla's valuation is further inflated by speculative investments in its technological promises, especially in areas like autonomous driving, AI, and energy storage. These are undoubtedly promising sectors, but they remain far from mass commercialization or substantial profitability. Tesla's full self-driving, FSD, software, for instance, has faced numerous regulatory and technical hurdles, and achieving widespread adoption of autonomous vehicles remains years, if not decades, away. Investors seem to be treating Tesla not as a car company, but as a tech company with the potential to revolutionize multiple industries, hence the sky-high valuation. However, if these speculative technologies are ever spun off into separate companies, as has been suggested for divisions like Tesla's energy business or its AI research, existing Tesla shareholders may not benefit from these future tech breakthroughs. New IPOs for novel technologies could dilute the current Tesla stockholder base, as the promising technologies might be housed in entirely different entities. If that occurs, Tesla as an automotive company would remain, but without the tech division many investors are banking on for long-term returns. This leaves shareholders exposed to the risk that the core business, EV manufacturing, might not generate enough profit to justify the current market cap. One of the critical issues underlying Tesla's speculative stock valuation is the tension between its identity as a tech company and as an automaker. Traditionally, automakers are valued based on vehicle sales, profitability, and market share, whereas tech companies often benefit from inflated valuations tied to future potential. Tesla's stock price seems to be caught between these two models, with investors treating it as a disruptive tech company, even though its primary business, manufacturing and selling cars, remains that of an automaker. This identity crisis is particularly problematic when considering the practical limitations of scaling an automaker. Tesla's push to expand its manufacturing capacity, grow vehicle sales, and maintain a technological edge requires significant capital expenditures, long lead times, and overcoming supply chain challenges that all traditional automakers face. While Tesla's innovation in EV technology is commendable, the company must still navigate the same production bottlenecks, regulatory issues, and competitive pressures as any other car manufacturer. The reality is that Tesla will struggle to meet the outsized expectations placed on it by its inflated stock price without monopolizing the entire auto industry, which is an unrealistic scenario. The speculative nature of Tesla's valuation presents significant risks for investors, especially those who have poured in their savings based on lofty promises of future growth. Much of the excitement surrounding Tesla is tied to CEO Elon Musk's charismatic leadership and his ability to communicate grand visions, whether it's fully autonomous cars, AI breakthroughs, or even Mars colonization through SpaceX. However, Musk's vision for Tesla may be more of a narrative tool to keep investor optimism high rather than a practical roadmap for sustainable growth. Tesla's reliance on speculative investments, rather than immediate profits, raises concerns about the long-term viability of the company returning substantial profits to shareholders. The company's focus on growth rather than distributing profits through dividends or buybacks suggests that shareholders may not see the traditional benefits of holding stock in a profitable business. At some point, the speculative bubble may burst, leaving many investors holding shares that are not backed by real profits. In conclusion, the speculative nature of Tesla's stock investment poses significant risks to its shareholders, as the company's valuation is driven more by investor optimism and the promise of future technologies than by its current business performance. Tesla's market cap, inflated by speculative expectations, far exceeds its ability to generate meaningful profits from its automotive business, and the likelihood that these speculative technologies will be spun off into separate entities further complicates the potential return on investment. While Tesla has undoubtedly revolutionized the electric vehicle industry, the current stock valuation reflects a disconnect between business fundamentals and speculative hope, raising questions about the long-term sustainability of such investments. Investors must critically assess whether Tesla's future can deliver the returns they anticipate or whether they are betting on an illusion that may never materialize.